Hey guys, it's David Vader here from All Time High, a crypto podcast. Got a bonus special episode for you today. Had the opportunity to sit down with Callan Sarre from Cryptocate. Cryptocate is a cryptocurrency tax reporting agency. They create tax reports for your accountant, make things a lot easier. I sat down with him and asked him a lot of questions about profit taking in general in crypto. What are the rules around pro trader versus investor? General tax rules in Australia, capital gains, that sort of thing. And then we kind of got off into the weeds a little bit. Very, very interesting way of exploring something that's generally a boring subject. Callan made it really interesting. So I hope you guys enjoy this episode and learn something. I know I learned a lot. And then we delve into a whole bunch of other stuff and get off into the weeds a little bit. But hope you guys enjoy. And thanks so much.
We're talking about a decentralized
world. Supply of dollars can never be sufficient to satisfy the debts that it creates.
Hello, Callan from Cryptocate. How are you doing?
Yeah, really well, thanks.
Hey man, I'm really excited to talk to you because, this huge run up in Bitcoin and altcoins has left a few people in the lurch as to what to expect from the tax man when the tax man comes, and really interested to hear your take on, what I guess your perspective is on, first of all, what Australians should do to avoid the tax man knocking, how to prepare themselves, and also to, I guess, your advice on moving forward as well, record keeping, that sort of thing. First up, introduce yourself. Tell us who you are and what your organization does.
Sure. My name's Callan. I'm a co-founder from Cryptocate. We started back in 2017. I've been working in the cryptocurrency industry since then. So seeing a lot of these cycles come through and a lot of change and growth and excitement build. It was very starkly contrasted by the early days. The level of adoption and the excitement we have, and the media attention and people looking at this space through legitimate eyes, I suppose, and really asking these questions about how can we be compliant, because people, your ordinary investors are interested in taking out a cryptocurrency portfolio and being compliant as a result. So there's been a lot of questions asked in that regard, but we're doing our best to answer them.
Yeah, right on. So all the way from 2017, I mean, back then when it started, there wouldn't have been much guidance from the ATO, right?
No, and I think the big thing was as well back then, it was just a simpler time. People would just be trading cryptocurrency or doing some staking, and that would be very exciting and out there. And then you've had this Cambrian explosion of DeFi, and it's like, well, what do we do now? I guess, Cryptocate as a company, we focus on cryptocurrency tax reporting. So we can put together reports for any type of investor with any type of crypto activity and make sure that they're in keeping with regulations, so that it takes the headache away from your accountant or from yourself personally if you're doing your tax. So we put together those reports and provide services around cryptocurrency generally. We've also got an advisory arm of the business as well. So we can do cryptocurrency consulting, specific projects consulting, as well as tax advice, which we're getting a huge demand for at the moment. Just people saying, what the heck should I be doing? One, but how can I optimize my tax as well? What structures can I look at in order to run a cryptocurrency investment portfolio efficiently in terms of your tax obligation as well? So those are questions that we're getting quite commonly.
Yeah, right on. I do want to get into, what your generalized kind of advice to, the end user or the end investor is, but I'm curious about the reports you're preparing for local accountants, because, Joe Blow, the accountant around the corner, or maybe one of the H&R Block guys, they're not going to know too much about crypto. In fact, a lot of them will probably be saying still, even though after this Cambrian explosion, what is Bitcoin?
Yeah, exactly. And I think there are quite a few issues facing the traditional accounting space in terms of understanding this. But at the same time, at the end of the day, there's some simple concepts that get applied across the board. I think the main thing that differs from cryptocurrency is the data. We've got all of these different locations, data can be generated. You've got your wallets, exchanges, you've got DeFi platforms, you've got smart contracts, and all of these things are producing data in a different way. got a different format. We've got a different download methodology and different accessibility. Some of these new blockchains, for example, don't have block explorers. They don't have a CSV export. And if you want to get the data from the on-chain activity that somebody's been conducting, you need to set up a node and request it from the chain. So it's still really early in that regard. And an accountant who's used to having a bank feed or paper receipts, and they understand where to get the data from the traditional system. But these days it's just become an entirely different ballpark and environment to collect that data, which can be really challenging. So I think it is a data issue as much as it's an accounting issue in terms of the reporting of cryptocurrency at the moment.
Right on. So once you've done all the yards in grabbing all that data, how are you presenting that to the accountant? Is it literally just a one pager? Hey, here's what's coming, here's what's going out, this is what's owed? Or
yeah, it'd be great if it was a one pager, but sometimes it's thousands of pages of transaction history. Not the raw data itself, but it's the taxable output of that. So at the end of the day, it depends on the investor type and the type of activity that they have. For example, if you're receiving income from staking, we generally treat that as we would put that into an income report. And if you're trading as an investor, it's generally capital gains tax, and we put that into a CGT report. So at the end of the day, your accountant gets a PDF document. It's got the key figures from your financial year, your capital gains, your capital losses, any long-term holdings, for example, and then your net position. And then all they need to do is take those values and submit them. So working with us for an accountant is just like working with any other kind of report, which is really easy for them. But we take all of the data complexity and the regulatory kind of complexity as well of cryptocurrency and boil that down into a simple PDF for accountants. So they love us.
Right on. Yeah. Got a lot of friends in the accountancy space, I bet.
Yeah. And hope to make more. Yeah.
Right on. So can you break it down for us? What is the difference between a pro trader and an investor in cryptocurrencies?
Well, it's kind of a bit of an interpretive area as well. And we provide advice around this to our clients. But it kind of comes down to the way that you're conducting your activity, and I would refer to the ATO guidelines around whether you're in business or not. And if you're classified as being in business, then you should be reporting as a pro trader, in my understanding of it. But if you're an investor, then things are treated as capital gains tax or income if you're doing income generating activity. As a pro trader, you've generally got a high volume. You generally have an ABN or a business plan or something that indicates you're approaching things from a business-like standpoint. And this is basically directly from the tax office guidelines. And then the taxable interpretation of your activity, instead of looking at things from a capital gains perspective, we're looking at things more as trading stock rules. So instead of tracking your cost base and calculating your capital gains and producing a capital gains report, we generally produce an income report for professional traders.
Right. Yeah. So that's for really professional traders. I guess there's some elements of complexity that come into just the investor category, where some people are trading fairly actively, even though they're just an investor, they're not a pro. How does that differ from, a long-term hodler? Is there a subcategorization there?
Not really. The only subcategorization would really come internally in terms of the complexity of the work that we need to do. If somebody, and these are the best clients really, they've just bought Bitcoin, they're like, yeah, I'm just going to hang on to it for 20 years and just need my annual statements. For like, okay, this is nice and simple. Welcome. It's not so much of a mess to clean up. But then, there are those differing levels of complexity with people's activity, and we treat everybody on a case-by-case basis because you might have some people, a reasonable amount, a couple trades a week, they're not taking things too seriously. And then you've got people, tens of thousands, hundreds of thousands. Somebody said they had 1 million transactions, and some of this is bot trading as well. But when you have a data set that large, it is a bit more of a task to reconcile that and make sure that we have everything in correct order.
Absolutely. I imagine like some of that must be automated, the ins and outs of these transactions. But of course, you have to go through with a fine-tooth comb and make sure it's all right.
Yeah, I mean, automation is great until it breaks, and then you're like, oh, well, how do I figure out where the leak in this 1,000-meter pipe is? Which probably isn't the longest pipe that has ever had a leak, but yeah, there are pieces that we automate, and we write scripts, custom integrations, take these data sets that the processing tools don't understand and integrate them so that they can be understood, and reformat things as required. But there's a whole bunch of issues, with your exchanges. Mostly in terms of data accessibility and accuracy can sometimes be an issue. You might get different data from a CSV export than you might from an API. So we've just got to look out for these things. And then we run the error reports. If we see there's a hole in the data set, we're obviously missing something, or there's some crap data that's got in, or when we need to do a reconstruction because the data is just missing, for example. So in those scenarios, it can take a bit of manual work, but we try to automate as much as possible. And that's kind of the idea as well, as like everything's on chain. You're never going to get a paper receipt for Bitcoin. And if you do, that's kind of hilarious in a way. So ideally everything's going to be on chain. So I think in the future, it potentially will be a much easier accounting problem. And I'm saying that very, very optimistically, because at the moment it's quite a challenge to look at all of these new projects and interpret the kind of taxable events that they can create. But hopefully in the future we have, everything's operating on a decentralized blockchain. We can have our privacy still maintained through secondary layer solutions, but then the reconciliation of your personal finances can happen relatively automatically once all of these platforms have been integrated with some kind of coherent ledger system.
Right on, man. That's so fascinating. And I really want to throw a couple of scenarios at you and get your really generalized advice, hashtag not financial advice, but generalized advice. Yeah, exactly. For a couple of scenarios. So would you be happy if I throw a couple of things at you and let me know what you think?
Yeah, of course. I'll try my best.
Okay. So first up, I think this is a pretty common one. Someone who has started investing in the rise up in late 2017, maybe they've bought a whole bunch of altcoins. They've got assets split across various exchanges, and some of those exchanges have gone kaput. They've died, bankrupt, gone, or scammed out. Maybe someone's bought BitConnect and or they've had coins on Cryptopia or something. What's your advice for those people that have a real jumble from way back then?
Yeah, I mean, looking back historically, data was even worse. I think that it's getting better and better. Exchanges are putting more effort into it as they become regulated as well. They have more of an obligation to provide good data. So back then, the data was generally worse. But in the case where you have a missing data set, we try to do a bit of a forensic analysis. So we can look at historical record in your emails. We can look at on-chain transactional data. We can look at, some of the history that you do have. Potentially there's an email that says, I deposited Bitcoin here and I withdrew this. We can treat the exchange somewhat as a black box. We won't be able to recover exactly the data that happens, the swaps inside the exchange or whatever specifically happened, but we can look at the general inputs and outputs and say, so Bitcoin went in, Ethereum came out. Based on the time frame, we can assume that there was a swap that occurred on this platform, and we can recreate a trade based on that, which at least will create a coherent system and transition some of the cost base across between the assets. But in those circumstances, we do treat it on a case-by-case basis. If people haven't lost data, but it's just a mess from 2017 back in the day, you'd be surprised by what is accessible. It just takes a bit of attention and going over things and interpreting things and picking up the pieces. Yeah, it's not the end of the world, but it just takes a bit more attention.
It's interesting because I guess if I'm interpreting this correctly, there's a little guesswork that needs to go into these exchanges that have maybe gone down. So maybe I had some coins in Mt. Gox. I was trading them. Maybe I built up an increased stack and I then transferred out before it went down. Let's say the records from Mt. Gox are all gone now, but those two transactions, the in and the out, are still there. And I guess filling in the gaps is something that you guys do or can do.
Yeah. We try to do that to the best of our ability based on the data. So we try not to guess per se. If somebody's like, oh, then I traded to this and then I traded to this and traded to this, they wouldn't ever be able to produce an actual like numerical amount of cryptocurrency unless they have a photographic memory. So we try to look at the actual data that we have and recreate it in terms of that data in the most logical ways as we can.
Okay. So scenario 2 is, I guess, something you described earlier as being one of the easier clients. Maybe it's someone who got in fairly early. Maybe they were before the 2017 bubble, maybe 2015, 2016, that sort of time. I remember buying back then. Bitcoin was done cash at the bank, and then you'd get sent some Bitcoin to a wallet. That is sure, there might be some on-chain data, but there's not a lot of data and exchanges and knowledge that's kept there for historical records. So what's your advice to someone like that that's maybe bought it more anonymously, and now they're sitting here with cost base of 0? Is that how it works?
Yeah, I mean, if we don't know where the asset came from, we'd ideally like to establish some kind of cost base. We can look at the historical price of the asset and whatever chart data we do have. If we had that public key, for example, we could see when it arrived. And if they've purchased it and there's a receipt somewhere, like that, we can usually establish the cost base. If there's no data, it's a little bit trickier, and we kind of need to look at that at a case-by-case basis as well. But we usually rely on the historical data that's available to us. And even, I remember, it was local Bitcoins or whatever it was, and you deposit your cash at the post office. But they still sent an email, I believe, or some kind of receipt. So we can kind of go through there and look at those records and at least see the amount, and there's some kind of receipt, and we can build it based off that. Haven't had too many people come through that have absolutely zero record, which is good. But I'm sure there's plenty of people out there that have some innocuous cryptocurrency from back in the day.
Yeah, and maybe some people that have bought off these local Bitcoins has, the coins have come from a known drug dealer wallet from Silk Road days or something. Is there any concern there, or is that excusable?
It's interesting because I've heard that concept before, kind of like I don't know, gray Bitcoin or something like that. I'm not sure exactly what the term is, but the notion that Bitcoin isn't necessarily fungible in that sense, in that each Bitcoin does have a history on chain. So I don't think there's any risk of my gut feeling to an individual if they've got a receipt for it. If they've bought it from local Bitcoins, that Bitcoin did happen to come through some darknet wallets, for example, I can't imagine the individual would be liable. And I also expect that to follow up each of the, if you were going to take a Bitcoin wallet from Silk Road, for example, and track that Bitcoin and see where it is now, and then knock on everyone's door and say, hey, did you use the darknet back in the day? I think as an operation, that would be quite significant and probably not worth it. But who knows? Yeah.
So probably not something to be concerned about.
No. Yeah. But generally, if you've got a receipt, try to get your Bitcoin from a reputable location. And it's so easy to do that these days. There's so many great platforms in Australia and all around the world that provide amazing crypto onboarding services. So just keep it simple. Yeah. Don't buy it off your mate, because that just means like, oh, how did you pay? Oh, I don't know, $50. I was at the pub. It's like, just try to do it in a way that you've got a record, and then you won't have any worries at all.
Yeah, fantastic. Yeah, there is that idea of colored coins, like there's even, it can even swing to the positive side where you can buy coins only that have been mined using renewable energy, as an example. That's something that's coming out of the States, something very interesting. All right, look, I guess the third scenario, maybe the last scenario I'll throw to you is, what if someone's fairly new to the crypto space? Maybe they've come in this year, or maybe, late last year as the rise up has happened. Records are all on exchanges. Yes, it may be confusing, but it's reachable. Is there any advice regarding the way to dispose of the Bitcoin? How do you sell it? How do you get out? Basically just the way you got in is the easiest approach.
people keep their own spreadsheets of transactions, and I think that's really useful to people that like to do that kind of thing for their own peace of mind and to have a reference to the actual data on the exchange as well. But we generally treat the exchange data as the source of truth. So, if you're trading on an exchange, we've got that data set. Every exchange does data differently, exports it differently, formats it differently. But we're across all of that. So my advice to someone just starting out, keeping simple, would just be to stick to one platform that really keeps the amount of taxable complexity to a minimum, while still giving them, plenty of opportunity to get started. I think that I personally think that people should hold their own keys. I understand services are, desirable for a number of reasons, and risk and all of these things associated with it. But I think it's just so cool when you plug in your hardware wallet, and you've got this wallet that has all your assets on it. You can interact with Web3 stuff with the click of a button, and you've got this identity that's tied to basically an anonymous, cryptographically sound device, which I think is a fantastic way to interact with the internet. So I would say, get a hardware wallet, practice transferring assets between your exchange and your hardware wallet, but just use the same exchange to go in and out. If you want to chase some random coin that's on a different platform, then you can create an account there. But yeah, if you minimize the complexity, stick to your spot trading, stick to your staking from the exchange or from your wallet. If you can run it all from your hardware wallet, it's even better. But I would stay away from the edge of crypto, where you've got the DeFi, the LP stuff, the yield aggregators or different products like that, because that's where the data kind of starts to get more complex, increases the price of your tax return, as well as just kind of entering into a bit of a regulatory grey area at the moment.
Right on. Is there wiggle room in that grey area for the benefit of the trader?
Absolutely. Yeah. I mean, it's just a matter of complexity at the end of the day. It's not a matter of if it's possible, I suppose. There's some of it we're kind of like, oh, this is way too much effort to get this data, because we'd have to set up a node or something like that. But it's just a matter of time. But certainly for crypto traders, people more experienced in the space, getting involved in DeFi, I think is some of the most fun I've had in crypto personally. And it's what gets me really excited about working in the space, is when you see these products that you couldn't even have imagined, and then you're just interacting with it in a completely new way. You get to be the master of your own portfolio, and you're not beholden to a company that maintains your assets or holds them on your behalf. So yeah, if you're into the space and you've got the understanding to do it, I would get involved. But be really aware of what you're doing. Keep a good record of at least the locations that you're trading on, so that you don't forget about anything. And if possible, keep it to simple interactions. Like a swap on chain is generally pretty easy to treat. But if you're doing LP and then staking the LP token, and then all of this kind of, you can go so many layers deep with crypto, then that following that trail on chain from platform to platform, and understanding what that interaction is, and understanding if that's a taxable event or how it should be treated, that's where it gets more complex. But yeah, there's ways to do it that keep it relatively simple while still being really exciting.
Yeah, right on. The DeFi stuff, it's really the realization of the earlier dream, right? I remember back in 2015, 16, it's like people are hyping up Bitcoin with these ideas about this fantastical future. And, we're seeing so much of that now. It's amazing to see how far it's come.
100%. Yeah. I personally get really excited about it. It's getting started in 2016, and it's like smart contracts. We can do all this stuff, and you're like, oh, I can't wait. That sounds awesome. And then you just sit there with Ethereum in your wallet, and you can't really do anything with it, and it gets a bit stagnant. But now there are so many products, so many different ways that you can leverage your crypto. And maybe it's a little bit of an echo chamber still, in that we potentially haven't bridged the traditional financial system and DeFi at this point in terms of providing value to consumers. But for a crypto enthusiast, there's so many things that you can do that do make sense. And it's the start of a whole new space of financial products that I think we're only starting to see the start of now. and just opening the doors to finance in a new way where, anybody with a Ethereum key can basically access this whole world of financial services regardless of where you are. So hopefully it leads to a more open and accessible financial system as well, which I think it's doing, except for gas fees at the moment. Yeah.
It's slow. You can lead a horse to water, but you can't force it to drink. You can open so many, doors to benefit people's financial sovereignty, but you can't force them to use it for sure.
Absolutely.
I do want to ask you, I guess, about the future of crypto in general, but first I want to get your take on the future of crypto specifically related to tax. Namely, that the other day I saw this platform where you could use your Bitcoin as collateral for a loan. Now, the loan has an interest rate, and that wasn't too appealing because it's still very high. But I imagine as a lot of competitors enter the field, those interest rates are going to come down, and it's going to be better for me as an investor to use my Bitcoin as collateral, never sell it, and take that money, maybe invest that elsewhere. I know a lot of people are looking to buy houses and things like that. We are in Australia. What's your thoughts on that?
I think that's really an excellent approach to things for people to actually access liquidity in their crypto investment. For example, I've worked with some clients using Celsius, which is a platform. It's not a decentralized platform at the moment, and that has its own considerations. There's platform risk, there's market risk, there's, if you're entering into a contract, you've got to collateralize that contract, and you're open to liquidation based on market fluctuation. So there's certainly a whole suite of risks that are associated with it, but you can manage them with appropriate thresholds and some notifications and things like that. But I think that using those kind of things are great for investors if you have your risk managed, because specifically at the moment, which is interesting, a non-decentralized solution can be more beneficial from a tax perspective, because from my understanding and the way that our chartered accountant has talked to us about it is, if you give yourself, or if you enter into a collateralized loan using Celsius, for example, you can receive Australian dollars for that loan, as opposed to a stable coin, or as opposed to some kind of secondary asset on chain. And the benefit of that is you can go and spend your Australian dollars, and you don't need to pay tax on selling your Australian dollars, pay GST and whatever else is associated with it. But as opposed to cryptocurrency, if I was to get a USDT loan, for example, using BTC on a decentralized platform, if I sell that USDT, it's still likely to be a taxable event. So it hasn't actually necessarily benefited me by undertaking that scenario, unless you were going to leverage it and you've got it all mapped out and you're in a strategic position. But yeah.
Interesting. So unless it needs to be, if I'm using my Bitcoin as collateral for a loan, really to have any benefit tax-wise, it needs to be in the currency that I'm going to be spending. So if it's in USDT, I can go and, maybe invest that directly somewhere. Whereas if it's in Australian dollars, I can then go and spend that into the market.
Yeah, that's how it works from my understanding. And in terms of interest rates, it's quite interesting as well. I think the on-chain interest rate is actually quite low on something like Compounds for borrowing Bitcoin. It's probably not as low as the standard kind of interest rate by the central bank. But on a platform like Celsius, which I think is interesting, and not at all affiliated with Celsius, I've just seen them operate and have worked with a couple of clients with them. But if you deposit Bitcoin into their platform, even if you're receiving a loan based on that Bitcoin, it's still generating about 4 to 6% interest in Bitcoin on the platform. So you've got the interest rate that you need to pay back the loan, but you're also earning a higher percentage of Bitcoin, not higher than the interest rate, but higher than if you were lending on Compound, for example, just by holding it and entering into that. So it's kind of being offset by the income you're receiving in terms of Bitcoin of your initial, and then you still have to pay back the other amount, of course, as well. But it's interesting how you can kind of have your cake and eat it too with cryptocurrency in many ways, and that you can enter into a staked position And there are other platforms that do this where you could stake an asset and then you receive a staking token, and then you can use that to leverage yourself in DeFi or something like that. And that gets complicated from a tax perspective, but I think it's amazing that you can do all of these, leveraging yourself and exposing yourself in different ways. And there's so many different layers you could take it to, and it's still really early days.
Is this what the young kids are calling yield farming? Yield farming. That is the general term. And yield farming, I guess, to me, the way that I understand it is kind of like a derivative on your primary service, I guess. Like, you could stake your Ethereum, receive a staking token for that, and then provide that staking token into an automated market making protocol, your Uniswap or your Curve or something like that. Provide liquidity there, and then you receive a token for that. And then on the platform, you can stake the LP token from Curve, for example, back, and then earn governance token on the platform that you're staking through in the first place, because a lot of them are operating as DAOs. It's interesting. I personally think that I'm personally a little bit hesitant because of this notion of impermanent loss, which is what happens when you enter into a liquidity contract. Where you enter in and say you provide 50% of each asset to, let's say, like Ethereum and DAI. You provide $5,000 worth of DAI and $5,000 worth of Ethereum, so you fill up both sides of the market. But then the Ethereum price goes to the moon. So $5,000 worth of Ethereum has become, where it was 1 Ethereum, it's become 0.5 Ethereum. So you receive back the same value of assets, but not really the same balance of assets, which can be complicated from a tax perspective, but also means that you've actually, you've lost your exposure to Ethereum by entering into that LP contract. So it's not all just sunshines and rainbows. There's also different risks associated with leverage, as always. Yeah, I see what you mean. That would not be a good outcome for sure, especially where we're perched now for the market. And I do want to get your take on that. But before we get into, I guess, more general crypto stuff, because I do want to, you're a guest on the show. I want to find out what you think's happening in the future.
Cool.
Just staying on the tax stuff for a little longer. New investors, what do they got to do? What do they have to do to make sure that they don't get caught out later?
Well, I would say do some research. The classic term in cryptocurrency, but genuinely do your research and keep it really simple. Like, don't look into the DeFi stuff, the best place to get your yield, etc. Just look into the basics. Like, how the heck does a blockchain work? What is asymmetrical key cryptography? And you don't need to call it that, but you need to understand what's going on when you send assets, how assets are secured, and how you can secure them yourself. So that's what I would personally really encourage people to do. If they're just getting started in the space, like, get involved in the technology to some extent. You don't have to build anything, don't have to be a developer, but understanding why it's different to what we already have, that'll help you across the board in terms of what you invest in, how you manage your own risk, and also just the kind of actions that you take in the space. Because if you're managing your own wallet and say you're running MetaMask through a hardware wallet, it gives you a great platform to interact with the crypto space, Web 3.0, but also gives you a bit of a platform to manage your data through as well. So all my wallets are coming through my hardware wallet. I've got a list of all the different platforms I interact with from that. And when it comes to end of financial year, you can kind of start with a list and start to piece together all of your different data sets, because you need to look at everything come into financial year. And my second shorter answer to that question would be talk to us and we can get you set up.
Of course. Yeah. The experts. Now, how important is it to get this stuff right quickly? Because I know there's we have Australia, in Australia, the financial year ends in end of June. Deadline, I believe, for putting tax returns in for the year is end of October. Am I right? How is that? How important is it to get it in that quickly?
Well, I would say stick to the deadlines that were given to the best of your ability, but don't get stressed to the point where it's causing a major issue in your life. If you're filing through a tax accountant, I believe you have until May to make your submission. So if you're new, you're worried about it, talk to an accountant, get registered through their tax portal. That needed to happen prior to October 31st. But speak to an accountant. Just make sure that you're not going to get hit with any unexpected surprises in terms of late fees or anything. But my personal opinion, and I don't want to be proven wrong in this, but is that things are relatively lenient at the moment because it is a very new asset. There's a lot of development in space, a lot of new treatments that are still making their way through, legislation. And there's also been just a crazy couple of years for accountants with COVID and, the government grants, the interpretations of businesses. They've just been smashed by this as well. And I think you speak to any accountant, they'll say it's been pretty tough time after COVID has been for everyone. But in terms of their work, it's certainly increased a lot. So yeah, I'd speak to somebody who knows the tax system can ease your concerns, because it will get done, but it's just a matter of timing. Try not to get overly stressed about it. Your data is there somewhere. It can be put together, but talk to someone that knows what they're doing, and they'll be able to help you out.
Now, in Australia, of course, we have capital gains rules for long-term hodlers that are different from short-term hodlers. Can you go a little into that and what the advantages are for hodling?
Certainly. According to the tax office, if you hold an asset for over a year, then you get a 50% discount on the capital gains tax that you would owe. So it's not you pay 100% of your gain and then you only pay 50% if you hold it, because it wouldn't make sense to pay 100% of your gain. It's 100% of the tax on the gain, or 50% on the tax on the gain. For example, I made $50,000 in capital gains trading Bitcoin, and then I'd held that asset for over a year. So if I was paying 30% tax, for example, then I would pay 15% tax on the gain if I'd held that asset for over a year. So you apply that discount to assets you've held, and then if you're just trading normally, you buy and sell the asset at the same time, then you get taxed capital gains at your normal tax rate, from my understanding.
Fantastic. Good to know, man. Let's get into a little more of the general Bitcoin, if you're down for it. I know, you're the tax expert. Cryptocate is the tax geniuses that'll take care of all my woes. But as someone who's been in the space for a while, I'm curious to hear your opinion about where you think it's heading, and particularly this cycle. Of course, I don't want to ask you directly for a price. If you have one, I'd love to know where you think it's going to end up. Don't feel the pressure on that, but I am curious about where you see the space going.
Certainly. Price-wise, I would not be able to help it at all. That's not my forte whatsoever. My intuition is on a long term, the industry is going to continue to grow. Projects will come and go, certainly. And we've seen that already, 2017 to 2018 boom. There are a lot of projects and a lot of promises, and some have fulfilled that and some have disappeared, spectacularly in some cases as well.
I'd say most have disappeared.
yeah, exactly. But in terms of the space generally, I think that we're going to start to see continued adoption and interest. I think there are just fundamental benefits to this system in terms of removing kind of bureaucracy, not necessarily in terms of, regulation per se, but in terms of just organizations that provide services. They'll still be able to provide services. I think people will always want services in order to manage things until we have a huge education and everybody understands it for themselves. But that's how we work as a society broadly, is to leverage each other's expertise. So I think they'll just change. They'll be easier for people to create. They'll be easier for people to manage. They'll be more functional. They'll have greater opportunity for leverage, and they'll be more accessible as well. I think another thing I'm really excited about generally as a concept, and one of the concepts that really got me excited about blockchain technology in the first place, was DAOs and their kind of potential to manage, tragedy of the commons type issues, as well as collaboration between trustless individuals, basically. Like if we can have a a cryptographic structure in which we can engage with each other, where everything is democratic and functional within that system to make decisions, then I think we can create these really novel and interesting ways of mobilizing people, mobilizing capital, and getting some really good things done in the world. Because I think that there's a lot of people that want to make positive change in the world, and hopefully these tools will enable them to, access capital, access exposure, and give them a safe way to collaborate without requiring necessarily a complicated and expensive legal structure in order to do that. We can instead take these modular DAO formats, plug and play, spin them up on secure networks, and get the right stakeholders involved through various mechanisms. So that's what I'm excited for. I think DAOs have been kind of like a silent success of this year, this calendar year at any rate. And I'm really looking forward to seeing what they do in the future as well.
Yeah, there's such a need for them, these decentralized organizations, essentially. I remember back in, it would have been 2017 maybe, Dogecoin community sponsored a race car. And I see that as such an opportunity for DAOs, because it could have all been done through this decentralized trust, essentially, and people could have voted on what's going to happen, which way we're going to go with it. It's
I had a one of the team members brought up to me today that there was a DAO that's trying to buy one of the original copies of the American Constitution, I think it is, and it's just like, all right, why? But then you think, oh, actually, that makes sense. Like, we're trying to mobilize people to take a common good and kind of have ownership of it, I suppose. As opposed to that kind of thing, which is for the people being owned by an individual, which is pretty commonplace. Why not have it owned by a great collection of people as well?
That's right.
I'm not sure how that works logistically, but yeah.
It seems like such a natural extension of where the internet was going anyway. You had the advent of social media where suddenly people with all this variety, some obscure interest can meet online, but really all they can do is talk, right? Which is a great thing. Sure, it's social, but now what they can do is they can own property together. They can buy things. They can contribute to causes. They can drive causes. Like, that's
absolutely,
you're right. It's a very exciting space. Yeah.
No doubt at all. I think that's why the phrase like Web 3.0 is so suitable to describing what's going on, because there would never been native payments on the internet. We've always had secondary services that provide that. We've never had native identity, and to a large extent, we haven't had native encryption either. So I think it's really interesting how these things are becoming just more of a base layer of the internet. We'll have payments. You'll have your Web3 wallets. It'll be integrated on every website. You don't need to give an email. You don't need a phone number. Your public key is your identity. You can create your credit score through your activity on chain, and you can piece all these things together until we have a meta personality based on these verifiable aspects.
You said the magic word, meta.
Yeah, I thought about it and instantly made me think of Facebook, but that's probably good marketing on their behalf.
Of course. Yep. They like to choose the most generic terms. Messenger.
Yeah. Wow. Thanks, guys. For everyone.
Is there any projects that you've got your eye on at the moment, in particular, that are that you're excited about?
Well, there's certainly projects that I'm keeping my eye on. I mean, one of my pet projects for ages, not that I have anything to do with it or can claim any of its success, but one that I've personally found very interesting and exciting has been MakerDAO. And I think that they've really pioneered a complete subsection of the cryptocurrency environment with a very clever implementation of smart contract technology, where you can collateralize a position in a smart contract with Bitcoin or Ethereum, and they've released multi-collateral DAO now, so you can use many multi-collateral DAI, so you can use many different assets in order to mint stablecoins or to mint DAI. And I just think that has been a really fascinating project to watch because it's operated as a DAO. They have created a primitive component of decentralized finance They have a decentralized stablecoin with a great incentive mechanism to get people to participate in it. And I think those kind of projects are what really excite me, the ones that are providing these kind of fundamental base layer services that a lot of applications will be built on top of. For example, there's another one, it's called Lido DAO, and they're basically an ETH2 staking DAO. I'm relatively new to the project in terms of my research and whatnot, but from my understanding is you can stake your Ethereum in an ETH2 contract when all of that goes live in the future. And then you've got a staking token which rebases itself to accumulate interest. And then you've got Ethereum that you can still functionally use. It's an ERC20 token, but it's also Ethereum that increases in value based on the fact that it's being staked at the same time you can use it. So it's kind of like your cake and eating it too again. And then you can use that token and leverage again, in many different ways. Or you can lend that token or whatever it might be. And there's just these really interesting use cases like, wouldn't you prefer to hold Ethereum that is also increasing itself in value based on the staking rewards of the base layer? So you've got this kind of secondary token that I think enhances the security of the network as well, because it encourages people to stake their cryptocurrency, but they still have the capacity to use it. So I think that's a really interesting application of decentralized finance.
I need to do a little research on that. Did you say it's Lido, Lido?
Yes, I believe that's what it's called. Yeah.
Okay. Yeah, I'll have to check that one out. That's interesting. I think that just about wraps up all these questions I have for you, man. I really appreciate you coming on. Can you tell the audience where they can reach out to you if they, need tax services or want to get in touch for any other reason?
Yeah, absolutely. Cryptocate.com.au. That's the best place to get in touch.
Description.
Yep. Awesome. Thank you. You can either, send us a form there. I'll get in touch with you, give you a phone call. We can book in a meeting, or you can submit a data form. It basically says, this is where I've been trading. It's kind of activity I have. I'm really sorry. I've been doing all this DeFi stuff. It's like, no, it's okay. But no, so that's the best place to do it. They'll come through our standard process, book in a time to have a chat with me or whatever you need. So we can help across the board. Cryptocurrency tax advice. We can do cryptocurrency reporting. If you're setting up an entity, we can assist with that as well. And then if you have cryptocurrency specific projects, if you need help setting yourself up securely, accessing some of these interesting projects that are emerging, and you want someone to help you through that process, then we can certainly assist there without providing financial advice, just practical solutions. So yeah. Awesome, man. And as I said before, I'll be sure to put all that in the description if you want to go ahead and check it out. Awesome. Thanks so much for coming on, Callan. I really appreciate your time, man. And we'll hopefully talk to you again soon. Yeah, been an absolute pleasure. Thanks, David.